Hey everyone, so this video is going to explain how to place stop losses for options trades. So let's get started. So first of all, let's pull up a symbol for a stock. Now I have currently opened the options order entry window, which comes from right here on the main window for TrueEdge. I'm going to type in QQQ. I hit enter, and now I have the quotes for options. Now, it's currently selecting the 492 strike price, but I can choose whatever strike price I want by clicking here and selecting whatever strike I prefer. I'm just going to leave it as is. Expiration, I can also choose whatever expirations are available. Again, I'm going to leave it as is, and I can choose call or put. I'm going to leave it as is for now. All right, so as of right now, I currently have my display set up to view the expanded order entry. If you don't have this selected, make sure you do, because if it's not selected, you won't be able to see all of the information that we'll need to see later. So I have expanded order entry bar selected. All right, now having done that, if I've selected an option with its expiration strike price and whether it's a call or put, next thing I have to do is choose the quantity. I'm going to leave it at 1, but I can of course change it to any quantity I want that's divisible by 1. And also market price is what I have selected if I want to buy at market. However, if I want to do a limit price, all I have to do is enter the price, and it would be based upon the current quotes that I see here. So currently we have a bid of 85 cents and an offer of about 86. So if I want to buy at 80 cents, I would type in 0.80. And now if I hit buy, it will place a limit order. But we're not going to do that. We're just going to buy at market for now. Okay, so as long as MKT is selected, when I hit buy, it's going to buy at whatever is the first available offer price. Also have to make sure this should automatically be populated, but if it isn't, make sure you have open, time and force is day, choose the account, choose the destination as NASDAQ, and then that's it. All right, so I'm going to hit buy, and now I currently have an open position for the 492 call that expires on October 24th. That's today. For the QQQ. It's today as the recording of this video, that is. Now, presently, it's going up in my favor, so that's what my position summary is saying. And down below, it's showing me that I had an order that was filled to buy at market, and it's showing me that my average executed price was 93 cents. So let's say I do not want to leave this wide open. I want to place a stop loss. So I'm going to choose close, and I'm going to select the price that I want to place the stop loss at. So let's say I want it to be at 80 cents. Okay, so I've entered 80 in here. Now I go down to below and I select stop or trailing stop. Let's do the normal stop for now, STP. So now what's going to happen is when I place this order, it's going to place a stop loss, a normal stop loss at 80 cents. That will close out this options position for the 492 call, expiration October 24th, 2024. I have to make sure, of course, that the option that I chose is still here, which it would be if that's the last thing I did. All right, so now I'm going to hit sell because I bought the option, so I hit sell, and now I have a stop loss that's placed at 80 cents to stop me out of this trade in the event the market goes against me. I bought in at an average price of 93 cents, so that means if the market goes 13 cents in against me, then I will get stopped out, and the stop loss will be hit. It will be triggered once we hit 80 cents, but that doesn't guarantee that I'll be executed at that price. That's the same for any stop loss that you ever use, whether it's for stocks, options, or otherwise. It can't guarantee you're going to exit at exactly the stop loss price. It'll be at whatever the current available bid price is at the time. So if that bid price is exactly 80 cents, that's where you'll get filled at. However, if it's not, if it's slightly lower, let's say the next trade that happens skips over the 80 cents and goes down to, let's say, 78 cents, then that's where you'll get filled. Okay? So just remember that. Now, currently this price is going up. Maybe I just decide that I need to walk away. I want to use a trailing stop. So the first thing I have to do is cancel this stop loss. Now, with the trailing stop, it's going to work a little differently. I have to tell it what amount that I want the trail to be. So if my entry price is 93 cents and I want my trailing stop to start out at 10 cents below that, then I would use a 10 cents trailing stop. So I'll put 0.10 as my trail amount. Of course, I will select the close, and then I just have to select TSTP for trailing stop. Now, remember, when I select TSTP, notice that this now says trail amount. If I switch it over to stop, now it just says price. So if it says price, that means I have a regular stop, and I'm actually entering the exact price that I want the stop loss to be at. When I go to TSTP, which is a trailing stop, I'm entering how far behind my entry that I want the stop to trail. So now all I have to do is hit sell, and now I have a trailing stop. The trailing stop is going to trail 10 cents behind the market. So if the market's going in my favor, then the stop loss will move up every time the market moves. So when the market moves 1 penny or more in my favor, the stop loss is going to be moved up to be exactly 10 cents behind the highest price that was achieved on the options that I have at that time. Now, if this keeps going down, we're going to see, there it is. I just got filled at 85 cents. Now, you might be wondering, why did I get filled at 85 cents and not 83? The reason why is because when I entered the trailing stop, the market had already moved in my favor. So because it already had moved up, the trailing stop when it was entered was going to be slightly higher than my entry point. So what that means is when you enter a trailing stop, if the market price of the stock has moved up beyond your entry point, then as soon as you enter the trailing stop, it's going to trail exactly behind where the market was at the time you entered that that trailing stop. So for me, that basically means that since the market was slightly up at the time, my trailing stop is now at 85, was executed at 85 cents, so it's trailing 10 cents behind. All right, so that's all that happens there. So now you understand how to enter trailing stops. Let's do it one more time just to see it, and I'll just do it quickly here. So in this case, I'm just going to buy another call option. This time I'm going to buy the 493 call. So now I've bought that 493 call at market, and now I'm going to put in that I want to trail by, let's just say by 5 cents, and I'm going to choose to close, choose the trailing stop, and then I'm going to hit sell. And now my trailing stop is 5 cents. That's going to trail behind my entry. My average entry price is at 40 cents. So therefore, that means if the options price gets down to 35 cents or lower, then it's going to trigger an exit, because again, my entry price was at 40 cents. So when I entered that trailing stop, I wasn't in a profit yet. In other words, the market hadn't moved beyond my entry point at that point. So therefore, the trailing stop is going to be trailing just behind where the market is. Okay, so as of right now, my trailing stop should get triggered at 35 cents. Okay, so other than that, it hasn't traded down to 35 cents, but let's see if we do. Last trade is at 38 cents right now. So if we trade down to 35, then we'll get stopped out in just a moment. So let's see if that happens. Okay, I'll give it another 30 seconds. If it doesn't happen by then we'll just conclude the video. All right, but either way, that's how the trailing stops work. And I showed you already, if you do a regular stop, then you just enter it. Okay, there you go. I just got stopped out there. See, at 35 cents, right? Exactly 5 cents below my average entry price, which was at 40 cents, as we saw earlier. So right there it says, I bought the options at 40 cents. I entered a 5 cents trailing stop before the market had moved in my favor, and I got stopped out exactly 5 cents behind. If the market had moved in my favor, then the trailing stop would always be exactly 5 cents behind where the market last peaked out for my position. Okay, so that concludes this video. Hopefully that helps. Thanks, guys.